Welcome and thank you for standing by. At this time, all participants are in a listen-only mode until the question and answer session. At that time, if you would like to ask a question, please press star then 1 when prompted. This call is being recorded. If you do have any objections, please disconnect your lines at this time. And now I would like to turn the call over to Mr. Tony Sargis. You may begin.
Thank you, Allie. Good afternoon, everyone, and welcome to this afternoon's webinar on DISC tax incentives for businesses selling abroad. I'm Tony Sargis, an international trade specialist with the U.S. Department of Commerce Commercial Service based out of Middletown, Connecticut. The Commercial Service is the export arm of the International Trade Administration. We have offices in every state and over 70 offices and embassies and consulates abroad. Just wanted to give a short intro this morning. We want to really focus on the presentation by our presenter today, Dan Gottfried from Roggen and Nassau. I'm just going to go over a few housekeeping items before we get started. The format of today's webinar, there will be approximately a 40-minute presentation and 20 minutes of Q&A. We will end promptly at 2:30. For follow-up questions, we can email Dan directly or you can get a hold of me. Also, there's a Q&A box at the top of the screen, so if anyone has questions during the formal part of the presentation, please feel free to ask those questions at the time, and we'll try to get to those. This webinar is being recorded, so we'll be sending a link out to everyone with a copy of the presentation within the next hour or so. Everyone should receive that, and if you have any questions on that, please contact me. Now I'd like to introduce today's speaker. Daniel Gottfried is a tax partner at Roggen Nassau. His practice encompasses domestic and international business transactions, as well as federal, state, and domestic tax planning, including corporate mergers, acquisitions, disposition, joint ventures, partnerships, and S corporations. Mr. Gottfried is regularly called to assist business clients with cross-border expansion, including expansion into the U.S. and abroad. I just wanted to thank Dan for joining us again today. He's going to cover the majority of this presentation, and like I said, we'll have about 15 to 20 minutes for questions and answers at the end of the session here. Take it away, Dan.
Okay, thank you, Tony. And I'd also like to thank the Department of Commerce and of course, everyone who dialed in today to participate. As Tony mentioned, I spend most of my time assisting clients with international tax needs. And in recent years, there's been a great deal of attention on domestic international sales corporations, or DISCs, as a tax incentive for businesses selling abroad. Today, I'd like to review with you some of the basic rules that surround DISCs and discuss some of the organizational structures that are employed to reap the benefits from DISCs. As Tony mentioned, 1 hour is going to be reserved for the session today. I anticipate speaking for about 40 or 45 minutes, and we can leave the rest for questions and answers. As a caveat and sort of a reminder, this presentation is really for general information purposes only. It's not intended to be legal or tax advice. And although sometimes I may be opinionated, just remember that any of my opinions are mine alone. They don't reflect U.S. Department of Commerce, my law firm, or any of my clients' opinions. And of course, my opinions should just be viewed as general commentary, not legal or tax advice. So what we're going to talk about today, here's a quick summary. We'll start with some background information regarding DISCs. We're then going to quickly review current federal income tax rates and then turn to a discussion of more specifically how DISCs work and what some of the technical requirements include. I'll then discuss with you some possible DISC structures so you can see how a DISC might be incorporated into your business or other different types of businesses. So by way of background, DISCs were originally established in 1971, so 41, 42 years ago. And the legislation has been modified many times over the years. Most importantly, there were changes in 1984 that led to what we currently call the interest charge DISC, or the IC DISC. You'll see this as an acronym, IC DISC, interest charge DISC, which is synonymous with what I'm calling a DISC today. Under today's rules, there's only one type of DISC, and it's an IC DISC. So I don't want to have the verbiage confuse you. One major change in 1984 with the DISC is that The IC DISC allowed for deferral of tax on certain DISC income, but the taxpayers have to pay an interest charge. That's why it's called an IC DISC. And we'll talk a little bit more about the deferral benefits in a few moments. Now, because the changes to the DISC rules in 1984 were so significant, that legislation actually terminated all DISC elections. And taxpayers wishing to have a DISC from that point forward were required to file new elections. As of 2008, there were over 2,000 DISCs in existence, and that number has been steadily growing since then. Unfortunately, I don't have a more current number. DISCs provide a number of benefits. Broadly, they're intended to stimulate U.S. exports and encourage businesses to expand in the United States. Some of the ways that they do this is by allowing for a deferral of U.S. income tax. Now, as I mentioned a moment ago, the cost of this deferral is an interest charge. So deferral only makes sense for taxpayers who can invest the deferred income with a better rate of return than the interest charge. And in addition, most DISC structures these days are established to benefit from the tax rate differential that we're going to talk about in a minute. And so actually the deferral mechanism for DISCs is less important these days than the next bullet point, to convert ordinary business income into dividend income. Most DISCs that are formed these days are intended to benefit from the rate differential between business income and dividend income. And we'll talk about that in a bit more detail. So by providing these tax breaks, Congress intended that DISCs would encourage businesses to expand in the U.S. And essentially making it less expensive to do business here in the U.S. Providing this kind of incentive. This applies particularly for U.S. manufacturing companies and in some cases for distribution companies. Now, just by way of background, the United States has had other export incentives over the years. Right now, the DISC is the only export incentive that's withstood the test of time. The other ones, in the late 90s, we had the FISC, the Foreign Sales Corporation, which was challenged by the European Union and repealed by Congress. We had what they call the Extraterritorial Income Exclusion, the ETI, which was also repealed based on a European Union challenge. But the DISC is still good law, and actually since the repeal of the ETI regime in 2004, coupled with the reduction in tax rates for qualified dividends, there's been a real resurgence in people's interest in DISCs. So most of the driving factors these days have to do with tax rates. As you probably know, at the end of last year, we were close to the edge, but we didn't quite go over the fiscal cliff. Instead, at the end of 2012, Congress passed the American Taxpayer Relief Act of 2012. It wasn't all good news. Tax rates were generally increased. For instance, the top individual income tax bracket went from 35% up to 39.6%. But importantly, the 2012 Taxpayer Relief Act preserved the characterization of qualified dividends and continued to tax qualified dividends at a lower rate than ordinary income. So currently, ordinary income rates, all corporate income, the top rate is 35%. And non-corporate, like individuals, the top rate is 39.6. But qualified dividends are taxed at capital gain rates, and for non-corporate taxpayers, like individuals and trusts, the maximum is now 20%. The other very important thing that happened in 2012 is that the qualified dividend rate became permanent. Now, I put permanent in quotations for a reason because, as you know, nothing is permanent. Congress is always able to change the law. But up until the 2012 Taxpayer Relief Act, the qualified dividend tax regime had an expiration date. And so in the past, if Congress did nothing, the rate would go away. Now that has been flipped, and the rate is permanent unless Congress takes some kind of action. So, looking at the end of 2012, it was more challenging to do planning based around qualified dividend rates because we were always concerned that you would build a structure in reliance on those rates, and then the law would change. Now we have a bit more certainty that the law is at least permanent for the time being. The other big change in 2012 was actually part of the Affordable Care Act of 2010, and this was the 3.8% Medicare contribution tax, what some people call the Obamacare tax. But this tax was enacted in 2010, but it wasn't phased in until 2013. So when taxpayers woke up on January 1, 2013, they had the higher rates for the 2012 Taxpayer Relief Act, and then also if you had net investment income for taxpayers making above $250,000 a year, they would have this 3.8% Medicare contribution tax on top of their regular income taxes. So big picture, rates went up, but there's still a pretty big spread between qualified dividend rates and ordinary income rates. And that becomes important as we think about how DSICs work. Now, most of the DSIC structures that are put into place these days are done so to convert business income into qualified dividend income. Now, it's important to know by way of background that when the fact that a DSIC could be used this way came to light with the IRS, some legislation was introduced to try and limit this benefit. And actually, Congress was vehemently opposed to limiting the benefit, and the legislation was shot down. And so it seems to be accepted at this point that Congress intends for this result and has blessed this result. A DSIC can be used to convert business income into qualified dividend income. The other reason why DSICs are set up, or the other concern that people have when setting up DSICs, is that you can use a DSIC to cause cash to be distributed to different shareholders. DSICs do not need to be owned by the same people who own the related supplier, nor do they need to be subsidiaries of a related supplier. And so we'll cover some different structures towards the end of the session today. But for now, just keep in mind that one benefit of DSICs is that you can cause distributions to key employees, you can cause distributions to family members for estate planning purposes, or for partners that are more involved in the export business. So a DSIC does not need to be owned by the same people who own the related supplier. The last benefit of DSICs, big picture benefit of DSICs that people think about, is deferring tax on DSIC income. This is often one reason why people set up DSICs historically, and in fact, historically, it was the main reason why people, or one of the main reasons why people would set up DSICs. Nowadays, because most DSICs that are being set up are being done so to benefit from the rate differential between business income and qualified dividend income, there's fewer focus on deferring tax. And that's because this rate differential, when you are paid the dividend, is a permanent tax savings. And there's a fear that if you leave the earnings in the DSIC and don't pay them out as a dividend, the rates may change and you may lose that benefit. And so I would say that deferring tax is something that people think about when setting up DSICs, but it's also something that's less and less important as people would often prefer to have the lower dividend rate apply. Now, there's two basic types of DSICs. The first type is called the buy-sell DSIC. A buy-sell DSIC actually takes title to export property, buys it from a related supplier, and resells the property outside the U.S. Now, buy-sell DSICs are less popular, mostly because they're more challenging to implement. They require the DSIC to actually take actions. The DSIC has to be in the supply chain. However, in some cases, they can be beneficial for DSICs that are seeking greater deferral of tax because of the way the deferral calculations work for a buy-sell DSIC. The more prominent type of disc is the commission disc. A commission disc is a disc that's treated as if it were a commission agent facilitating export sales for the related supplier. A commission disc is very popular because it's very easy to implement. In fact, it doesn't do much of anything. It typically lives in a drawer, as they say. It has no employees or operations. It's simply entitled to receive a commission based on a contract with a related seller, and it receives that commission in a sort of a passive way. So commission agent discs are much more popular. The other benefit to them is that customers really don't see a commission disc. It's only a seller-side relationship. It's not something that the customers need to worry about. Now, it's also theoretically possible for a disc to accommodate both buy-sell transactions and commission transactions. There's no prohibition on that, but to the best of my knowledge, there's really no examples of a disc doing that because typically they're going to want to fit into one basket or the other. And as I said, most choose to fit into this commission agent concept. Now, because so many discs are of the commission type, my discussion today is going to really focus on commission discs. Now, it's important to know that many of these concepts are going to apply in the same way to buy-sell discs, but I find it easier to just speak of one category at a time. So how do commission discs work? Well, first, the operating company, the related supplier, makes its export sales of qualified export property or sales of qualified services. And we're going to discuss in a minute what these terms mean. But for now, just notice that the sales may be export property or qualified services. So the related supplier, the export company, makes this sale, just like it would do in the normal course of business. The operating company, the related supplier, then pays a commission to the disc. And we'll talk in a moment as to how this commission is calculated. But what's important is that the commission is deductible to the operating company. Okay, this is a key point. The operating company reduces its taxable business income by this deduction. So it's worth up to 39.6% in terms of tax savings. Now, the disc itself is tax exempt. So it receives this commission, but it has no corporate tax liability with respect to the commission. It receives a commission, but it's tax exempt. Then when the disc distributes its earnings, which typically in the case of a commission disc, there's minimal operating expenses. So typically, virtually all the commissions are going to be distributable as earnings. That distribution to the shareholders is a qualified dividend for non-corporate shareholders. So the shareholders receive a qualified dividend, and they pay tax on the qualified dividend rates, which currently are up to 23.8%. Now, I'm using 23.8% as being the total of the maximum qualified dividend rate plus the 3.8% Medicare contribution tax rate. Now, that's not the rate that will always apply. It's going to depend on the taxpayer's situation. I'm just comparing apples to apples in this example. The maximum value of the deductible commission is 39.6. The maximum tax rate that would apply on the qualified dividend is 23.8. So I'm assuming the highest tax rate in both cases. In this example, there's a reduction of 15.8 percentage points, or about 40% of the tax is reduced simply by setting up a commission disc and having the commission routed through the commission disc and then distributed to the shareholders. Now, for some people, the narratives aren't too effective, and so I also want to review a mathematic example. In this example, you see existing structure. We're going to assume that the export company is an S corporation or an LLC, some kind of pass-through entity. and we're going to assume that it's owned by individuals, by natural persons. In the existing structure, the first column, you see that this business earned gross receipts from export of $5 million. After paying its expenses and overhead, it had net income of $2 million. So obviously a simplistic example, but if their taxable income was $2 million and they had the 35% federal tax rate, they would have $1.3 million of cash after they pay tax, right? A 35% tax rate, $2 million of taxable income, $700,000 of tax, $1.3 million left over to spend. If this very same business were to set up a DISC, in the columns to the right, it says DISC structure. So we have our same S-Corp/LLC, the pass-through operating business company. It's making the same sales of $5 million. It has the same net income of $2 million. But here in the box, calculation of DISC commission, it's going to pay a commission to its related party DISC. And we'll review the calculation in a moment. For now, let me just say it's a higher of 4% of gross receipts or 50% of combined taxable income. In this example, the DISC commission would be $1 million. So the operating business is going to deduct $1 million from its taxable income, and it's going to pay, or its owners will pay federal income tax on the business income of $1 million, and so they'll pay $350,000 of tax in their capacity as S-Corp or LLC owners, and have cash left over of $650,000. The $1 million that's paid to the DISC is a DISC commission. As I mentioned before, it's not taxable to the DISC. It's theoretically able to be distributed entirely out to the shareholders immediately. So if the shareholders receive $1 million dividend from the DISC, they'll pay tax at the qualified dividend rate. In this example, I use 15% qualified dividend rate of $150,000. So their cash after tax from the DISC is $850,000. Now, if you add that up, the $650,000 they received from their operating business plus the $850,000 from the DISC, they're left with $1.5 million of after-tax cash. A pretty significant savings, especially, as I mentioned, when in the case of these commission DISCs, besides the setup and maintenance, the DISC itself doesn't do a lot other than collect the commission. Now, of course, the amounts and the tax rates and the margins of a business are going to change for each business, but the principle is fairly universal. When a business can convert ordinary income into qualified dividends, there's often substantial savings for the owners. So following up on how DISCs work, I've mentioned that a commission DISC can charge a commission. The commission is based on qualified export receipts. And we're going to discuss the definition of qualified export receipts in just a minute. And although I want to point out, although the slide is talking here again about commissions, the same principles apply for buy-sell DISCs, and instead of being commissions, it's really the markup. It's the difference between the price that they buy at and the price that the DISC would sell at. So this commission is typically the greatest of 4% of qualified export receipts. These are gross receipts from qualified exports, or 50% of the combined taxable income. The combined taxable income is the total of the DISC and the related supplier's taxable income from the sale of export property. Now, for a commission DISC, which really, as I mentioned before, doesn't do a whole lot, this is the combined taxable income is essentially the gross receipts from the related supplier from the sale of export property minus its expenses, of course, before considering the DISC commission. As a rule of thumb, the combined taxable income method will apply for any business when the net margins are greater than 8%. The other way the commission can be calculated is by the fair market value of the services provided by the DISC. Now, typically, transactions between related parties must be at fair market value, and the IRS has discretion to recharacterize transactions to make sure that they're at fair market value. The DISC concept is a big exception to this rule. In the DISC context, the DISC is able to charge a commission at 4% of qualified export receipts or 50% of combined taxable income, even though those amounts may be far in excess of the fair market value of its services. In fact, as I've mentioned, most DISCs perform very, very little in the way of services, and the fair market value is next to nothing. And so the 4% and the 50% rule become very, very important. In addition, a DISC may charge a commission on 10% of its export promotional expenses. These are promotional expenses incurred by the DISC. And the slide mentions that this typically doesn't result in tax savings, and that's because typically leaving these promotional expenses in the operating business will result in a better after-tax effect than having the DISC incur those promotional expenses. It's the same rate differential that we spoke of before, but just the reverse. If the operating company incurs these expenses, it will have a greater benefit from its deduction than if the expenses are incurred by the DISC. The other rule that needs to be kept in mind is that a commission can't result in the DISC having negative taxable income. So you can't create losses in the operating company by paying commissions to a DISC. Now, often it will be difficult to calculate a commission with perfection by year end. There's a rule that says that an initial commission must be estimated by year end and paid within 60 days of year end. But the commission amount can be finalized and paid off 90 days thereafter, as long as what was paid by year end was a reasonable estimate. And so there's a little flexibility in calculating this as the books are completed through the course of year end closing. So a key issue is, what are qualified export receipts? Qualified export receipts are receipts from qualifying export sales. So this includes a sale or lease of export property. And the term export property we're going to talk about in a moment. But a sale or lease of export property for direct use, consumption, or disposition outside of the U.S. Now, although title does not need to pass outside the U.S., the property must be sold for use outside the U.S., and there can be no further manufacturing or production of the product here in the U.S. So a sale to a U.S. manufacturer would be problematic. A sale where the product is going to be incorporated into another product here in the U.S. and then exported, that type of sale is problematic. We're really looking here for export sales. And there's a hard and fast rule that the property must actually be exported within 1 year. Note also that this includes a lease or rental of property if it's going to be used outside of the U.S. And in the case of leases and rentals, the rental payments would be the qualified export receipts. In addition to the sale or lease of property, which we think of as sort of typical exports, provision of services can also qualify as export sales. And these are services that are related to and subsidiary to any qualifying sale or lease. Typical services include design, repair, warranty, maintenance, installation, transportation. All of those services may give rise to qualified export receipts that can be paid through a DISC. It's important to note first that the DISC itself does not need to perform these services. The work is typically performed by the related supplier, and the DISC is just paid a commission. It's also important to note that the services can be performed inside the U.S. So this isn't a rule of where the services must be performed. It's a rule of whether or not the services are related and subsidiary to the qualifying sale or lease. The other common type of export receipts is engineering or architectural services for projects outside of the U.S. This includes, outside of the U.S., that concept includes proposed locations that are outside the U.S., even if the project is never actually consummated. This can include feasibility studies, design, engineering, construction supervision, but it does not include these sorts of services if they're connected with the exploration for oil. But again, with engineering and architectural services, the services themselves may be performed inside the U.S. As service providers know, it's an amazing benefit if you can take service income and turn it into qualified dividend income, and that's the opportunity that's available for services that are related to sales of export property, as well as engineering or architectural services. So what's export property? Export property is property that's manufactured, produced, grown, or extracted in the U.S. by a person other than the DISC. So first note that there's this requirement of manufacture and production. This typically requires that there be some kind of substantial transformation of raw materials into a finished product, or that there are substantial manufacturing operations here in the U.S., or that conversion costs, the direct labor plus the factory burden, account for 20% or more of the total cost of goods sold. Things like packaging, labeling, minor assembly, those are not going to qualify as manufacture and production. The property must be held primarily for sale or lease in the ordinary course of business for direct use, consumption, or disposition outside of the U.S. This is called the destination test, and we touched on it a little bit on the last slide as well. Once the property is sold, there can be no further manufacturing or production in the U.S. There can be actually no use in the U.S. at all. In practice, this means that purchasing agents are generally okay. If a business will make a sale to a purchasing agent in the U.S. who will then export the property or sell to a related party outside the U.S., that's typically works out okay. But if the supplier is supplying a contractor or manufacturer, generally this is not going to be okay. Because typically in that case the property would be incorporated into something larger, it would be used or otherwise consumed here in the U.S. And as I mentioned before, there's this 1-year rule that the property has to actually be exported within 1 year. The third qualification for export property is that not more than 50% of the fair market value can be attributed to imports. So it's okay to incorporate some imported articles into the export property, but the value of those imported articles, the raw value as of the date that they're imported, must not exceed 50% of the total value of the export property. This you could think of as sort of a made in the USA provision. Now it's important to notice here too that the incorporated U.S. articles and or the value that's added here in the U.S. doesn't necessarily need to be added by the related supplier who's selling to the DISC. There can be other U.S. organizations that are involved in the supply chain. The final qualification here is that the property cannot be sold or leased with other related DISCs. So the related supplier and its affiliates can only use one DISC in the supply chain. Now, there are some notable exceptions to export property, and I want to touch on a couple of them. First of all, most intangible property is not export property. There are some exceptions to this. For example, computer software can be export property, and some other copyright type assets like recordings and things of that nature can be export property. But by and large, intangible property is not export property. Most depletable property, oil, coal, uranium, unprocessed softwood timber, most of that sort of property is not going to qualify as export property. Property that's subject to export controls or listed by the President as being in short supply is not going to qualify as export property. And property that's been leased or rented by a taxpayer to a related party typically won't qualify as export property. So there are some exceptions, but by and large, I think this helps to give you a sense of what the qualifications are to have export property. Now, there are also some technical requirements for DISC qualification. These are typically fairly easy to account for, especially in the case of a commission DISC. But let's review these quickly. First of all, the DISC has to be a corporation organized in a state or the District of Columbia. It has to be a U.S. corporation. Now, typically the state where the related supplier is located is where you'd form a DISC, although some advisors recommend Delaware or Nevada as being states that don't have a corporate income tax. Particularly, some advisors would recommend that if the state of the related supplier does not itself exempt DISCs from corporation tax. My home state for Connecticut, for example, does have a corporation business tax exemption for DISC income. DISCs are not subject to the corporation business tax in Connecticut, and I think that this is really the majority view. But it's important to to look at this on a state-by-state basis. A DISC may only have one class of stock, so all stock must have the same economics. A DISC must have minimum capital of $2,500. Now, this is typically very easy to accomplish, but I point it out because it's really against the grain of sort of modern corporate planning. Most corporations that are formed these days are done so with negligible stated capital. Here, you have to have $2,500 of stated capital or par value. To be a DISC, the corporation must affirmatively elect DISC status. This is done on Form 4876A, and it's a fairly straightforward form, but it needs to be filed timely for the DISC status to be recognized. Now, to be a DISC, at least 95% of the corporation's receipts must be qualified export receipts. Now, we spoke of qualified export receipts just a moment ago. In the case of a commission DISC that distributes its dividends annually, this really isn't the problem because virtually all of its income is going to be qualified export receipts. You can run into some issues, however, with DISCs that seek to accumulate income and try to defer taxes, and of course you can run into problems with DISCs that have other activities. But single-purpose commission DISCs usually don't have a lot of problems with this test. And then the last qualification is that at least 95% of its assets must be qualified export assets. And you probably have a sense of what this means. But I want to give you a quick overview of qualified export assets. These assets include export property. So, of course, this is the big one for the buy-sell DISC that's actually taking title to property. The other things that is included in qualified export assets are accounts receivable and temporary investments of working capital. Now, as I mentioned, for commission DISCs that distribute all their earnings annually, now this is typically no problem anyway because they may have an account receivable through the end of the year, but they get paid whatever working capital they have gets distributed out. Typically doesn't raise a lot of issues. The final two that I listed on this slide are producers' loans and export-import bank and similar government obligations. These are more common with respect to DISCs seeking deferral. The interest charge rules permit DISCs to reinvest their earnings in certain qualified assets, including producers' loans. These are loans to the related supplier or certain U.S. government obligations. Now, if the DISC is able to collect interest on these obligations in excess of the interest charge it must pay to the IRS, there can be a spread that can benefit the DISC. However, a DISC may not defer and reinvest more than $10 million. In practice, as I mentioned before, most small and middle market businesses don't find the possible benefit on this spread to be worth the additional complexity and transaction costs of making these investments. And as I mentioned before, because most DISCs these days are seeking to benefit from the permanent tax savings on the qualified dividend rate, most of them prefer to take the cash now at a known tax rate rather than risk future changes to the tax laws. But the DISCs that are looking for deferral may invest in these producers' loans and the government obligations, and that is a qualified export asset, if it's done correctly. Now, certain corporations are not eligible for DISC status. Tax-exempt corporations, banks and trust companies, mutual funds, S-corps. But please note that just because a DISC cannot be one of these businesses or one of these entities, it does not mean that the related supplier cannot be one of these entities. On the contrary, any type of enterprise may form a DISC and use the DISC in the way that we're speaking of. For example, an S corporation cannot be a DISC, but an S corporation could be a related supplier to a DISC, and that sort of structure is seen frequently, and we'll go over in a moment. DISCs are not required to perform any functions or have any economic substance. Now, this is a key point because unlike most tax structures which really need economic substance, a DISC specifically does not need it. In the case of a commission DISC, the DISC itself typically performs no activities at all. It doesn't have any property other than the commissions that are paid to it. And otherwise, as I said before, it basically lives in a drawer, and it's not visible to anyone outside of the related supplier and its accountant. So a DISC doesn't need to have any office space or employees. It really doesn't need to do a whole lot. There's a lot of flexibility with respect to the identity of DISC shareholders. Entities can be shareholders, individuals, non-U.S. persons, and the shareholders of a DISC do not need to be the same persons as own the related business. So if you set up a DISC, there are certain other requirements to keep in mind. First, a DISC will need to have one or more legal agreements. They will need to have an agreement with a related supplier, often called a commission agreement or a franchise agreement, which details the payment of the commission. A DISC may need to have sales contracts, particularly a buy-sell DISC. There may need to be a cost allocation or apportionment agreement, particularly if a DISC is providing services or wants to consider making additional tax elections that could benefit it. If a DISC is making export promotion expenses, it may need an agreement detailing those expenses. And if a DISC is performing managerial services, it would need an agreement detailing those services. And depending on the context, other agreements may be necessary. Now, a DISC should keep books and records that substantiate the calculation of commissions, the status of qualified export receipts, and other qualifications. And there's some pretty detailed tax regulations that go into what is required in that regard. And then, of course, as I mentioned before, the DISC is going to need to calculate its commission and keep records of the payments of commissions. A DISC files a U.S. tax return. It's Form 1120 IC DISC. This is filed annually, and as you notice, the due date is different than the due date for most income tax returns. It's the 9th month after the tax year ends, so that's September 15 for a calendar year DISC. There are no extensions allowed, and all DISC returns get filed at the same IRS office in Kentucky. And as I mentioned before, there's often no state corporate tax return for a DISC, but depending on what states are involved, it needs to be confirmed on a state-by-state basis. So I want to walk through now a few examples of what DISC structures look like. And the first structure I want to look at I've called a simple structure. This more or less matches that simple calculation that we walked through earlier in the session. And here the DISC is owned by an operating entity, and we're going to assume the operating entity is an S-corp or a partnership, in short, a pass-through entity. So here what would happen is the S Corp would pay a commission to the DISC, and it would take a deduction on the commission that reduces its ordinary business income. This income would otherwise be taxable to the owners of the S Corp or partnership at rates up to 39.6%, but it's going to be deducted. And then the DISC pays a dividend back up to its parent company. The dividend is a qualified dividend, and it's actually separately stated on the owner's K-1. So the characterization as a qualified dividend flows up to the owner. This applies for any non-corporate owner, like an individual or a trust. They would benefit from the qualified dividend rates. So in this situation, it's fairly easy to set up the DISC, because here the DISC compliance is essentially the responsibility of the existing business, and the owner still receives just a single K-1 from the business that includes the business's operations as well as the dividends from the DISC. This is a slightly more complex structure, but only because we've assumed that the operating company is a C Corp. If the DISC were owned by a C Corp, the DISC income would be subject to double tax, right? Just like any other C Corp income. And that means that from the DISC, if the DISC were owned by the C Corp, first the C Corp would pay tax on the dividend it gets from the DISC, and then when that's distributed to the owners, the owner would pay tax on the dividend. So instead, for a C Corp, especially in a closely held context, you generally look to have the DISC owned directly by the shareholders of the C Corp. And as with the prior structure, the DISC commission or the markup would reduce the taxable income of the operating business. And so that results in this deductible commission of up to 35%. And then the DISC, when it pays a dividend to the owner, it's qualified dividend income. As I mentioned, the DISC is tax exempt itself, so there's only a single level of tax here on the 23.8% maximum rate to the owner. So this is a way not only of reducing the owner's tax, but also helping to mitigate the effect of double tax in a C corporation. So this next structure is much the same as the prior, but it points out that foreign owners of a DISC may benefit from lower DISC tax rates under applicable treaties, which can be as low as 0%. And aside from possible benefits with tax treaties, foreign owners that are not corporations, again, like individuals or trusts, can also benefit from qualified dividend rates. And in most cases, for foreign owners, the 3.8% Medicare tax does not apply. So what's interesting here is that although foreigners are accustomed to setting up C Corps for U.S. operations, in many cases when a DISC is indicated in one of these businesses, they're better off owning the DISC directly, even if they also own a C Corp to conduct the operating business. I should add, in any event, that this is a complex topic and requires a sort of more fact-specific discussion based on, where the foreigner is resident, what treaties may or may not apply, and so forth. But it points out that when foreign owners are involved, sometimes a DISC can work a little bit differently than when domestic owners are the only ones involved. The last slide that I want to talk about illustrates that a DISC does not need to have the same ownership as the related supplier. And in fact, there are many reasons why it might not. The fact patterns that arise most frequently include the following. Number one, that the DISC is being used in part to reward key employees, either those that are involved in the export business or higher level managerial type employees. And so this allows the employees to get a stream of income that's often subject to this qualified dividend rate instead of ordinary income tax rates, and is linked to their export activities. Second reason that this type of structure arises is to drive additional returns to the owners or investors who are instrumental in the export business. So it allows you to essentially segregate some of the revenue from export and pass it through to the people who are involved in it. And the third reason that comes up is to provide for estate or financial planning needs of the business owner, essentially to have heirs or estate planning vehicles own the DISC and the cash flows associated with the DISC. And so those are some reasons why people might set up a DISC that has different ownership than the related supplier. That concludes the prepared part of my presentation. And I hope that you've really been able to pick up a little more background on DISCs, and I invite any questions now.
Hey, thanks a lot, Dan. Appreciate you taking your time this afternoon to discuss this topic. Allie, could we take questions at this time?
Certainly, thank you. At this time, if you would like to ask a question, please press star then 1 on your phone. Please make sure to record your first and your last name so I may introduce you. That's star 1. One moment, please.
I have some questions I see on the screen that, Tony, if you want, I can address them.
Yeah, sure. While we're waiting for the first question to come in, we can go into that.
Okay. The first question asks if there's a maximum limit on how much income may be passed to the DISC as a commission. And there isn't a limit on what can be passed to the DISC as a commission. If the DISC is intending to defer tax, there's a $10 million limit on that. But if the DISC is operating as a pass-through and passing its earnings out as a dividend, there's no limit on the commissions it could receive.
Allie, we have any questions?
I do have a question from Victor Valdez. Your line is open.
How you doing, Victor?
Good. I'm calling from Seattle. There seems to certainly be several costs associated with just setting up the DISC and then all the administrative costs that go with it. Did you say there's kind of a ballpark figure of, say, the level of revenues being flowed through a DISC that would actually make this beneficial to a firm?
Yeah, it's a difficult question to answer without more facts. I mean, you're absolutely right that there's startup costs and there's yearly administrative costs. Each business kind of needs to review what its expected savings is going to be to get a sense of whether the costs are worth it. We also have done some planning when for businesses that sort of don't have enough revenue on their own to kind of pool them together with other businesses to try to share in the administrative overhead. But you're absolutely right. I mean, part of this whole exercise early on for businesses to figure out, is it even worth it to set up a DISC?
Thank you. Any other questions, Allie?
Actually, no further questions at this time.
While we're waiting for the next question, I did send out an email to all the participants with a copy of the presentation and the recorded link. The recorded link will be available by tomorrow morning, probably 8 o'clock Eastern Time. So give it a few hours and you'll have the recorded version, and you should also have the copy of the PDF of the presentation. While we're waiting for a couple more questions.
I can answer a Q&A that I see on the screen here. It
Okay.
asks if an operating company, can you have an operating company be a buy-sell DISC and also have a separate company as a commission DISC? Well, there's no prohibition against having a buy-sell DISC and a commission DISC, or having a single DISC do both. An operating company may have a tough time qualifying as a DISC unless really all that the operating company does is export sales, because the requirements of being a DISC include the requirement that 95% of receipts are qualified export receipts and 95% of assets are qualified export assets. So typically, it's usually not good practice to have your supplier, your operating company, also try to qualify as a DISC, just because those tests would be hard to meet. It's a lot more common and better, I would say, to have a single-purpose DISC that's going to be managed in a way to ensure that you always meet those requirements.
Okay. I saw another question come in, Dan. It says, do dividends paid from the DISC need to be paid in proportion to the percentage of shares owned?
Yeah, and the answer is yes. I mean, DISCs have a single class of stock rule, and so dividends have to be paid pro rata. There are some structures, for addressing the desire to have income flow in other ways, but the DISC itself needs to have a single class of stock.
Okay. Allie, any other questions?
I do show the next question comes from Dave Wood. Your line is open.
Okay. How you doing, Dave?
Good, thanks.
All right.
I sell a lot to domestic customers who install a piece of software in my machine and then ship it overseas. Does something like that qualify as an export sale if it goes over within a year?
Well, it could. Tell me the facts again.
I ship my product to a domestic customer. All he does, my product's like a computer. All the customer does is put a piece of software. He installs his software in my machine, and then it gets shipped overseas.
Yeah, you could have a problem with that. I'd need to know a lot more of the facts and look at it more closely. But one of the problems that comes up is if there's any further use of the product here in the U.S. before it's exported, it can be disqualified. And we have to look at it in a lot more detail to figure out whether that act of putting software on it on the product is considered a use here in the U.S. It concerns me, based on the description, but I don't know enough to really comment definitively.
Thank you. Allie, any other questions?
And I show no further questions at this time.
Another question came in, Dan. Are larger publicly traded companies permitted to set up DISC?
Yeah, the answer is yeah, absolutely. What we see now is much more interest in DISCs among middle market companies and among foreign businesses coming into the U.S. There's no prohibition against publicly traded companies using DISCs. The issue for public companies is that they would typically be more interested in using DISCs for deferral of income tax, and really not interested in using DISCs to benefit from the tax rate differential, because of course public companies don't benefit from qualified dividend rates. So yes, there's no prohibition against it. Plenty of public companies have used DISCs, but it's typically more of a deferral mechanism than a rate differential mechanism.
Okay, great. Allie, any questions at this time?
I do show another question from Sale Lojavaro. Your line is open.
How you doing?
Hi, how are you?
Good.
I got a question. We sell domestically and internationally. The sales we sell domestically to a sister company that is located overseas. Would that qualify?
That could qualify. Yeah, we need to. I mean, the identity of the purchaser is often less important than where the product is going and being used. But yeah, I mean, it's not saying on the face.
Ship it to the States, and they ultimately ship it overseas.
Oh, okay. Yeah. So that sounds like it would typically qualify.
Okay.
Any other questions, Allie?
I have no further questions.
I guess if there's no further questions, I just wanted to thank Dan for taking time out of his day to present today. If anyone has any further questions for Dan, he's offered his email address up there. You can contact him or contact me. You should have received the link with the recorded version and a copy of the PDF presentation. And I just want to thank everyone again for joining in on today's call. Thank you. Thank you, Allie.
That concludes today's conference call. Thank you for your participation. You may disconnect your lines at this time.